Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about the pros and cons of dividends or dividend stocks just in general, and what to look out for. So I got three major points of the pros and maybe the opposite of each of those three. So, but before we do get into that, of course, we'll go into what the update is at the beginning of the week here. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. If you're not new, welcome back. And so, as you can see on the portfolio here, today we closed out at $13,957.57, down $53.72 on the day. For the 1 week, we're up $550.13, up 4.10%. For the 1 month, we're up $1,050.95, up 8.14%. For the 3 months, we're up $783.33, up 5.95%. And for the 1 year, we're up $675.72, up 5.09%. And for the all, we're up $1,826.64, up 15.06%. These are all the positions that we currently hold in this portfolio. And we have $74 available for trade and $100 coming in so we can make a purchase this Friday. So yeah, that is the portfolio as it stands. I'll leave it on the day because, yeah, it's the day. But maybe we'll just leave it on the all because we're back up to the 15%. Which is fantastic. July being I think one of the best months thus far this year. And of course, the first 5 months absolutely just tearing everyone's portfolio apart, but not a big deal. So let's talk about some pros when it comes to dividend stocks in general, and not just the portfolios itself, because they are quite attractive in a lot of ways. But the number one pro when it comes to dividend stocks, well, specific ones, because we'll get into the cons as well. But they're not dividends are not for everybody. Don't get me wrong, and I could be biased when it comes to this kind of stuff, but hopefully not. And so, pro number one is insulation from the stock market. Dividends typically aren't as fickle to the market when it comes to the demands of investors. So let's say you have a company, let's say like Tesla, for example, doesn't pay a dividend, which is fine. But on the whim of investors, if anything changes, this goes for tech companies, not just Tesla in general, but tech companies itself. One little thing changes in the market, and for some reason they just drop like crazy, and that's not everyone can stomach that happening or stomach that feeling at all. And so when it comes to dividend stocks, typically well-established companies that pay dividends, that can afford to pay their dividends, and we'll get into that later, are insulated. And what I mean by that is kind of protected by the stock market. Even when 2020 came, a lot of the bank stocks that we own in this portfolio, nothing changed with their dividend. It stayed the same. They were just frozen at the time, so there were no increases at the time, no share buybacks or anything like that, but they continued to pay those dividends. And in times like that, it does become very helpful in that scenario. So that's number one, is insulation from the stock market. They don't fluctuate as volatile as maybe a growth stock. Now, the opposite of that is not the opposite, but let's go to the pros first, actually. So pro number two is the fluctuation in dividends. They don't fluctuate the same way that a regular stock does. In fact, they don't move at all. Because the thing is, the company's size plays a factor in dividends, but some massive companies choose to reinvest those that portion of profits back into the company to grow the company, which a lot of investors can find very attractive. Whereas companies that pay dividends don't have this massive growth side to them. And they really don't need to entice investors to invest in them when it comes to the growth stocks like tech stocks. But when it comes to dividends, it is very enticing if you're more focused on that side of things. A dividend that has paid out, has a track record of paying out dividends year over year and continue to do it and still have a positive cash flow, but continue to grow, but more of a modest growth and not a massive 30-40% growth in a year, but have a dividend growth throughout the year, as long as they're not restricted by any governing bodies when it comes to these companies. So there is that as well. Pro number 3, which is, I think a lot of people probably have it for their number 1, is dividends provide a reliable income stream. Whether it's in a tax-free savings account, whether it's an RSP, whether it's in a non-registered account. Now, tax implications do affect each and one of those differently, other than a tax-free, which does not cost you any tax, other than the 15% withholding tax from U.S. companies that pay out a dividend. So I guess, all 3 have their own tax implications. Go seek out your tax advisor. I'm not one. I'm just a guy here on YouTube making videos and showing you guys my opinion and how we go on about building a dividend portfolio. So it can be a reliable source for income, especially those in retirement that are not looking for huge volatile swings when it comes to the stock price. And these dividends typically provide that for a lot of retirees or even younger people if they walk into a huge amounts of money and just dump it into dividends. Now, there are also always 2 sides of the coin. And so there are cons as well. Number 1 con when it comes to dividend stocks is the less potential for massive gains. Now, Apple might be a different scenario to that, and Microsoft, because I do believe those both pay dividends, but not a very large dividend. They're typically under 1% when it comes to their dividend yield. Now, that's just reality. A lot of the times, mature companies will pay out dividends, and that means that's less money, less capital that can go back into the company to continue growth. Now, it's a different story when it comes to different sectors. Now, if you're looking at banks, for example, Canadian banks, heavily regulated, maybe over-regulated, very difficult for them to expand into different demographics, like the US or internationally. We don't you look at Canadian banks, TD, as in the US. A lot of the Canadian banks are in the US and expanding that way. But when it goes to overseas, you don't see as many prominent Canadian banks as you do North American banks like Citi Financial, Wells Fargo, those kind of companies. You typically can see those overseas quite a bit. Another bank that is almost everywhere is HSBC, which you can see pretty much everywhere in that sense. So less potential for growth because they typically take their capital and pay out to investors in the form of a dividend, which is kind of a con in the sense that we can't get the massive gains in the stock itself. But that's fine. If you're a dividend investor, your goals are probably different than that of a growth investor. Now, it doesn't have to be binary where you're either growth or you're either dividends. You can have a mix. So just have that there. Con number 2 is the disconnect between dividends and business growth. Okay, like I said before, sometimes a company can grow, but it's not required to pay out a dividend. It's not legally bound that they need to. It's always down to management. Let's say profits go down and they can't afford to pay a dividend. This is kind of, I think, REITs play. You can really see this in REITs. Now, it's not typically a dividend. It's kind of called a distribution in that sense, I believe, in REITs. But in REITs, their dividend or their distribution is paid out in a very fluctuating amount. It's not a set amount. And so it's not, there's just a disconnect, right? So Whereas Canadian bank stocks, or the stocks that we have, there's nothing that typically changes in the dividend amount other than the yield, but it is what it is. The other one is like companies that maybe are not very good at creating cash flow. And I'm not talking about recently, but before, energy companies, I just didn't understand. I still don't understand how they're able to pay out these dividends when there's no positive cash flow in their business model, and tons and tons of debt. It confuses me, and so I'm still trying to figure that out. I've been doing it for a long, like investing for not a long time, but enough to try and figure it out. But I'm just flabbergasted by how they're able to pay these dividends when maybe sometimes there's not a positive cash flow. Now, in most recent times, yeah, I get it. They probably started to make money, but what's going on with their reserves? So yeah, so there can be sometimes a disconnect between dividends and business growth, but it's not always the case. So because dividends are paid out through cash flow, sometimes businesses don't cash flow, and it's totally up to management. They can decide to cut that dividend right away. And which leads us to our third con when it comes to high yield dividend traps, as we typically know them as, are these companies that pay out a very large dividend yield, and not the dollar amount, but a yield. So let's say a company stock is $50. They paid out a 5% yield. That stock drops $10, and the yield all of a sudden jumps up to 10%. Now that is a very scary thing, because what's that saying is that something happened to the company itself, business-wise. Maybe earnings were bad, stock price goes down, dividend yield goes up because they're committed to paying that yield. And what that typically will say is that 10% of their free cash flow is getting eaten up by dividend payouts instead of being used to grow the company in an expanding format or a profit growing strategy. And so management in a company can typically cut those through their dividend policy or allocation policy around what they do with the net cash flow. Do they use it to grow? Do they use it to pay back investors? And so on and so forth. So a lot of times it can be very attractive for investors to look at a yield of 11, 12% in a stock and think, oh, that's a huge yield, I'm going to go for it. But this is where due diligence has to happen, is we have to look at what the company is producing as a net profit, a positive cash flow, and how much are they paying out from that net amount in dividends, and how much are they using it to growth. And if it's not enough and they're paying almost everything to the investor back as the form of dividend, they have no money left to continue growth. And so what does that mean? It kind of means it's just a stagnant company. And so those are the three. I know this video is kind of all over the place, but I really wanted to get it out there because I think at some point this video will come in handy. And so other than that, guys, hope you guys did enjoy the video. I hope you have a great week. We'll see you on Friday when we make our purchase. Don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. Thanks for watching. Bye.